Please subscribe, like, and hit that notification bell. Thanks, guys. Do 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 do. All right, guys. Okay, all right. So you have about these targets for gold, silver, uranium, oil, SPX. You have to stop thinking about nominal values. Your brain, it's very hard for us to imagine higher up numbers, logarithmic numbers. Because people are all focused on their day to day. So let's say your younger self, your first job, I don't know, you were making $20,000 a year. But then I tell you that in 10 years or 20 years, you'll be making $200,000. It's hard to fathom that because right away your brain tries to contextualize that. And the only thing you know, because you haven't looked at charts, you haven't looked at the past, you don't know that your grandpa's salary was $2,000, right? You think it's always been 20,000, or it's hard to see, to visualize. So you take that big salary and try to bring it today and say, oh, Pat, imagine that huge salary. I'll be able to buy a big house. I'll be able to buy a fancy car. But what you don't understand is when you get that salary in 10, 15, 20 years later, you'll probably be able to buy the same house or maybe less. You'll be able to buy the same car or a little bit better car, depending if you got pay raises because you moved up in your line of work. But there's not going to be much difference. The only difference is the loss of purchasing power, the increase of zeros just added to any number. And of course, numbers go up and down. Nothing goes in a straight line. But the more they're printing money and the less there's GDP production, real GDP. So when you remove the inflation aspect from GDP, then this phenomenon just keeps repeating over and over and over again, right? So now, I don't know how old you guys are, but if you've seen 10 years of action and you've been working in the workforce for 10, 15 years, you've seen this. You've seen that a carton of milk was half the price back then. You've seen that oil at the pump is a tenth of what it's costing today, etc. So it's super hard to see the future in those big numbers. So don't let that say, oh, Patrick, it's a hopium. Look, whatever the numbers are, I don't care. I know they'll be bigger than what they're today. But I'll show you what's more important is listening to when the ratios top, because these numbers, the constraint of these numbers, sorry for the long monologue before I dive into charts, but this is, I got to put the context. It's all about relationships and ratios. Oh, Patrick, oil can't go to above 300. It's going to break the system. Yeah, well, if your salary went up 2-3-fold, you'll be able to buy that oil at 300. So does it really matter? Like I said, they're just adding zeros. Destruction of purchasing power. So whatever it is, it adds zeros. What you have to look at is when things are stretched versus one another. When the price of energy is too cheap versus the price of growth stocks, let's say the SPX. If the price of energy is too expensive, it's versus the price of the SPX. And when you look historically, when those ratios have topped or turned, whatever the price is, so whatever reached that crazy $1,000 target for oil, or whether the ratio peaks at a $300 target for oil, that's it. You bought something that was cheap, you ran it all the way to when it's expensive as defined by that ratio, and you cash in the difference. It doesn't matter what price it is. It doesn't, as long as the price is higher and you've played cheap to expensive as defined by the ratio, you've won, guys. It's that simple. So right here, let's start with the SPX. So here's the SPX. I didn't put the SPX adjusted for PPI. This is just a pure SPX chart, and I overlaid the silver chart. Here, when the SPX breaks down, look at the price. Here's a little mountaintop. Here's the price, breaks down. Silver dips, takes a hit when the initial, everything sells off. Then silver starts going up, 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 up. But it goes up higher, see? From that low, went higher. Or even from that starting point, went higher. And SPX, 21 years later, it came back to the same price. So once it got out of its bear market and broke out into a new bull trend, or out of that base, then that's when silver stagnates. And that could put gold was pegged, could put oil, and a whole bunch of other stuff. So let's move to today. rising trend line for SPX, not today, but the precursor to the 1970s, breaks down from this rising trend line, slowing momentum. 10 years later, right here, that's the price of the SPX is the same. And look, that's exactly when silver tops. When silver tops, that's when the price is practically the same for the SPX. When silver tops, it was exactly the beginning of the bear market for the US equities below that rising trend line. Silver dipped at the beginning, then rockets up as US equities go sideways. All right, 1980s, goes up, beautiful trend line, rising trend line, silver goes nowhere. Here, breakdown from that mountaintop, goes sideways. When silver peaks, that's exactly the same point where this thing started unraveling, not from the longer trend line, but from that top. I could have probably zoomed in because it went in on, it really didn't melt up. I could have put a rising trend line. But when this started rolling over, practically the same price for when silver tops. Silver dips, then goes up all the way again. Again, here, rising trend line. Now, SPX is now broken down below that trend line. I know it's broken down versus PPI. Currently, it's breaking down versus uranium. It's very close to breaking down versus gold, but hasn't done it yet. But it has broken down versus PPI. So we have to wait for this to really break down to know what level to pinpoint where would be in 10 years for the SPX. But it's probably good. Now it's at 4,200. It's going to be probably, if this is the top that we're getting, this is probably going to be close to it. So you could say maybe conservatively SPX in 10 years or whenever it comes back up, whenever silver peaks, whether it peaks in 10 years, 15 or 20 years, you could expect SPX to be close to 4,000. So this is important because this is the constant. Because all the ratios, how I derive the prices for my crazy targets for gold, silver, uranium, oil, they all came from thinking that SPX will be 4,000. Sometimes I thought 3,000, but then when I looked at this chart, I said, Patrick, there's high chances that they'll nominally be afloat, be able to keep the SPX afloat, even if it goes down. But by the time the SPX is back at the inception where it broke down and silver peaks, then that'll be it. Okay, all right, so where are the targets? So now we know the constant. The constant is going to be SPX. So the SPX is going to be 4,000. So let's start with gold to SPX. Let's see if I know that hold on, XAU USD divided by SPX. So if I know that gold will be, zoom out, line chart. If I know SPX is going to be 4,000, and I'm talking about peak insanity, guys. So let's say we ever get back to this type of ratios, right? Because right now, I'll show you one thing. Hide the drawings. Right now, we're practically at the same level that we were in the 1970s. In the 1970s, the ratio for gold to SPX went from gold being 0.4, 0.5, half of a percent of the price of SPX, but by the time of the bull era was over, it peaked at over 6. So gold was worth 6 times the SPX. So let's say the price action does go up. My lines appear again. Okay, remove drawings. So let's say it does go up and we go reach those highs, guys. Here's a huge W bottom. So whether it reaches it in 10 years, wherever this breaks out, 2020, 33, 34, whatever it is. Because right here, guys, it's massive W-shaped bottom. Early final breakout line. Let's see. Early breakout line, something like that. So whatever happens here, let's say it goes 6 to 1. So 6 to 1 is calculator. Right. So if we know the SPX is going to be 4,000 by the time when gold peaks, there is 24,000 for gold, guys, right here at the end of the bull era. At the end of the peak, it's not going to stay there a long time. Don't think it's a peak ratio. It's going to be extreme. Yes, everybody's going to try to get gold out of the ground. This will be peak. It's not going to stay there long. It's just to show you how stretched it could be. Right here, if we get just back at this neckline here, right here, let's say we get this peak here, this mid-cycle peak. And this mid-cycle peak, the gold to SPX ratio was starting from much lower, so it ran out of gas by here. But right now we're starting from a higher point. If it breaks out, I'll do you the breakout line. If it breaks out here, we're closer to the 70s or higher low, right? We'll have steam. We don't have to come from the basement. We'll have steam to have this type of run, but added to the breakout line. Even if we get here halfway through, so I don't know, let's say in 6 years, in 2028, reverse symmetry move, break out of this base, right here, 2028, 2027, don't know how fast it's gonna go, 5, 6 years. Even here, it's a 1.5 to 1. So if I say SPX is gonna be here, times 1.5, that's $6,000 gold just for the halfway point. But I'm going for the end game just to show you the extreme. So here I have 24,000, okay? 24,000 for the peak. Let's look at XAU, USD. Let's see silver now. This podcast might be slightly longer than what you're used to, but so here I'm going to go to the peak in 1980. And it was a 18 to 1, smaller time frames, 15 to 1. If ever we get this type of ratio, even here could stop maybe 33 to 1. So let's say I take that $24,000 gold. If we go to 1980s type of ratio, that would make 1,300 silver. If I would take the 2011 peak, put it on the daily chart, that one was 30, sorry guys, 30, about 31, 32. So let's go 24,000 divided by 32. That's 750 silver price. So that's how you derive it. It's just simple ratios. It has everything to do with the behavior of gold, how it's priced in relation to silver. No matter what gold price, if the gold price is lower and we hit that ratio, then silver price will be lower. If the gold price is higher, then silver price will be higher. This is ratio. So this should be our target right now for ratio, for the gold silver ratio. Now let's look at uranium. So let's say I have the uranium chart. I need to get my uranium ticker. Condiel. All right, so let's measure uranium divided by SPX. I'm going to remove this and that. I get to keep it clean. So look at that. You know what's maybe a better way? Here. I'll do it the opposite. It'll be easier for me to read it. I'll do SPX. Because gold is a bigger number, you could put in front. There you go. That's going to be easier for read. So now I know that in where's my peak? Okay. Put a monthly. Reset chart. All right. Sorry, guys. Bear with me. In 1980, and I think the data, I'll probably have to go back lower, but this has a 3 to 1 with the price of the SPX. So SPX back then was, I'll overlay SPX. Well, I don't even need to know what it is back then because now we know the constant of the SPX is 4,000. So if my ratio, if we end in 10 years, that the SPX is, and I'll put this one here also, the SPX is 4,000, and I know that my end game ratio that for the SPX to uranium target is 3 to 1. That gives me my 1,300 target for uranium. Again, it all depends how much money they're printing. There's a huge base right here, W bottom. How low is it going to go? It all depends how low that goes. Now, if we stall at 11 to 1, and that's when we get out of the bear market for US equities, as defined by SPX, breaking down on its own chart, or SPX divided by the PPI, even 11 to 1. So let's say I know the SPX is going to be 4,000 by the time we end, divided by 11. That gives you a 360 price target for uranium. Again, you got to forget about these numbers. Wherever this ratio turns down and starts creating a base and goes back up, so right here, peak price for uranium versus SPX, eventually, it's what I call a wake-up line. As long as the price action stays below this wake-up line, you stay long. As soon as it closes above, then that's the SPX starting to outperform uranium, and then you know that you should lock in whatever gains you have. Whatever the nominal price of uranium is, it's going to start underperforming the SPX, and your money should be somewhere else. It's going to be the same thing here. How low is that going to go, guys? I don't know. Is it gonna, as long as it stays below this wake-up line, then you know that uranium still has room to outperform SPX. So you're on the cheap side here, especially once when it breaks down below this line. Cheap, but with opportunity cost reduced, because now you're in a solid downtrend. And until it closes back above here, you ride it, guys. Whether you hit my 333 target here or you hit my $1,300 target here, whenever that turns up, that's what it's going to be. All right, I'm going to put oil. And oil, guys, it's practically like uranium. You'll see that chart. Same thing. See, that goes down. So I'll put you my low watermark, high watermark target. So here's a 2008 gold, uranium, and oil peak ahead of time, ahead of silver. Silver and gold, they're the late comers in the bull era. But at the beginning, you get the best bang for the buck by playing uranium and oil at the beginning of a breakdown of the SPX. So where are my targets? 9 to 1, a little bit like the 11 to 1 for SPX uranium. And down here, I have a 2.6 to 1, close to 3 to 1. So same math. Could practically same targets for, so let's say you imagine you have 4,000 for the SPX when it reaches nominal highs again, and then it breaks out of its bear market, divided by 2.68. So $1,500 oil. Patrick, you're nuts, but that's what the chart's telling me. That ratio is telling me that if I have a nominal constant of SPX at 4,000, which this has previously been shown, guys, I'll just refresh with the chart. Every single time when silver peaked, that's what was practically the value. And even here, mid-cycle low in 2008, when oil peaked, uranium peaked, it was back here. SPX was at that line, guys. So let me go back here. So 9 to 1, 10 to 1. So let's say, Patrick, I don't think we'll ever go back to 1980s. Fine. I'm not going to argue with you. And then you divide that. So that's even a $444 target for oil once we get just back to this neckline here. But that's going to create a huge double W. And this neckline here, if ever it breaks down, then look at my target. So don't need to get crazy, guys. Say, Patrick, it's too far. Look at the chart. That is my greedy endgame target. But that's just a roadmap. If the chart stays, it has to stay here below the wake-up line. Just going to put that wake-up line. So until you get back above that type of line, you ride it, guys. You ride it. Oil is outperforming SPX, and that's where your assets should be, guys. That's where your cash should be. And until something like this happens where it breaks back above, then you know that's it. That's all she wrote. I'm going to go long SPX. You ride it up. You ride long the SPX. But as long as you're below this line, there's a sleep mode line here. And there's a breakdown line here. So it's losing momentum already. So now that's how I derived all these targets. You can Also, I'll do one more to make it fit. Just a brick for the, I'll do the silver to SPX. So let's say I'll put the bigger number here, SPX. Oof. SPX divided by silver. Because I did it with versus gold, right? But I'll show you versus silver that the numbers, they still add up. Holy boy, look at all these lines. So I'm going to remove all drawings. Here, peak silver. And look, you'll see it looks like the, look at these charts, are beautiful. It looks like the gold, the uranium stocks, W bottom. If it ever breaks down, guys, from, okay, I'll call that the sleep mode 9. I'll show you that, guys, sleep mode. It's already starting to lose momentum, guys. When you see these lines break out, it's steep. So it keeps going up and you think it's in a solid uptrend, but what's happening is more something like this here. Steep goes up, but eventually when that next breakdown line, because that low here is creating that possible trend line here, when that is closed below, then you know that the momentum has really toppled over. Get something like that. Maybe something like that here, if closed below that. So let's just look at the target. So here it was, silver was at 28, 35, hold on, 28. So my 2011 target, 28 to 1. So I know, again, let's go back my 4,000 because I know I'm repeating myself, but just to anchor that, I have a constant of SPX, been shown in the past that is the end game. So now divide by 28. I have a $140 target for silver right here. If ever silver comes back all the way down here, that's a 140 move. So this type of line right here, I call that the wake up line. As long as you stay, wake up line, as long as you stay below that, you ride it because silver's not performing. So whenever this happens, and I'm going to stretch it to show you that this reverse symmetry move, these are reverse symmetry moves that could happen to this, but once that breaks down, and that's a W bottom, W top, if that breaks down, then the move is going to be some crazy move down here. And here, it was 3 to 1, 2 to 1. And guys, it's the same ratio that SPX to uranium was, right? 3 to 1. Same ratio that SPX to oil was, right? 3 to 1 about. So let's put that 4,000 divided by 3. And here's my $1,300 target for silver, guys. That's how I get it. So all these ratios, they match, they fit. It all depends of the time. It all depends if you think, so right here, there's just time to get here. Depends how fast that falls. Once that started falling, guys, it went really fast. Depends how fast this thing falls to get down here. And after that, how fast is going to, if ever it breaks down below that, the reverse symmetry move, that went down pretty fast here. The reverse symmetry move a little later. So 10 years, 15 years, right? 15 years going to bring us in 2037. That is a type of timeline to put to that. But like I prefaced this whole interview, this whole podcast, guys, it's very hard to fathom these numbers. So forget about the nominal numbers. Think about the ratios. So when this ratio starts turning back up, you're going to go in an asset that's outperforming. And as long as that ratio tumbles down, then you know that you're on the correct, you're the asset that's outperforming the other one. And that's how you have to see it. No matter what the price is, when you hit that, if it goes back above, that's it. Whether silver's at 300, 200, 400, 150, you're out. And that's how you manage risk, and you manage this concept of buying cheap versus buying expensive, guys. All right, hope this helps. And don't forget, subscribe, like, and put in your comments. I'll try to respond to everybody. Thank you for watching. Ciao, guys. Please subscribe, like, and hit that notification bell. Thanks, guys.